All right, there's a ton of noise out there about Lanka IOC. You've probably seen the headlines. Well, as your Optivest forensic analyst, I'm here to cut through all that chatter. We're going to dig into the data and uncover the real story behind the numbers.
So you see crude oil heading towards $100 a barrel, right? There's conflict brewing near the Strait of Hormuz, and it's giving a lot of investors some serious déjà vu. It feels just like 2022, and everyone's thinking, here comes another golden year for LIOC. But is that really the case? Let's pump the brakes and look at the actual facts, not just the feeling.
Okay, here's our game plan. We'll kick things off with that $100 oil déjà vu. Then we'll look at why 2022 was such a perfect storm. After that, we'll talk about the great margin squeeze happening now, uncover LIOC's real profit engine, and finally, build your new investment thesis. Okay, first up, the $100 oil déjà vu. You know, it's all about separating the market noise from the financial reality. Let's get right into it.
So here's what everyone's thinking, right? You see pump prices going up, and the immediate thought is, wow, LIOC must be raking it in. That's the investor expectation. But here's today's reality, and this is crucial. Those same rising pump prices are actually squeezing the company's margins. It's the complete opposite of what happened before. The entire game has changed.
So why is it so different now? To get that, we need to rewind the clock to 2022. Let's analyze what made that year such a one-off anomaly, a true perfect storm.
It really came down to three key drivers that all hit at once. Think about it. First, you had a supply monopoly. The country was in a forex crisis. State-run stations were literally dry, which meant LIOC became the only reliable supplier. They captured pretty much the whole market. Then, boom, a pricing revolution. A new fuel price mechanism came in, and for the first time, LIOC could charge prices that actually reflected their costs. No more subsidized losses. And on top of all that, there was a currency play. The rupee was depreciating sharply, and that allowed them to make some very favorable price adjustments, especially in high-margin areas like lubricants. And what was the result of all this? A staggering 16% return on capital employed. I mean, just look at that number. That's not something you see every day. And it's so important to understand, this wasn't just about high oil prices. It was a direct result of those unique, once-in-a-lifetime monopoly conditions.
Okay, so that was then. Now let's talk about the great margin squeeze. This is where we break down why today's market is a totally different game. That old formula just doesn't work anymore.
Think back to 2022. LIOC had a de facto monopoly, right? State supplies were disrupted. They were the only real option. Fast forward to today, and the landscape has completely flipped. We're talking intense competition. You've got new international players like Sinopec entering the market. LIOC just doesn't have that same pricing power anymore. They're not the only game in town.
And look, you don't even have to take my word for it. This is straight from Lanka IOC's own annual report. They're telling us, in their own words, that gross margins are getting compressed. The pricing framework that was once a huge benefit now actually limits their ability to pass on cost increases to us, the consumers. That's a massive, massive shift in how their business works.
So what does this squeeze look like on paper? Well, check this out. We're seeing a real growth mismatch. For the first time, their costs are actually growing faster than the revenues. You've got revenue growing at 5%, but the cost of sales is climbing at 7%. That gap right there, that's their profit margin getting eaten away. This is the squeeze, plain and simple.
Okay, so if the money isn't gushing from the fuel pumps like it used to, you have to ask, where is the real profit engine for LIOC hiding? This is probably the most interesting part of their story right now, the part most people are missing.
The answer is pretty surprising. The real earnings driver for LIOC today isn't the fuel pump at all. It's the treasury. In a world of high interest rates and inflation, how they manage their money has become their absolute core strength.
And I'm not kidding about the firepower. The company is sitting on a staggering 30.7 billion rupees in short-term investments. I mean, think about that. That's not just cash lying around. It's a huge strategic asset that gives them incredible liquidity and flexibility. And that money is not sitting idle. That portfolio generated almost 5 billion rupees. That's 4.96 billion in finance income last year. That's a solid, steady stream of cash that has absolutely nothing to do with whether a barrel of oil is $80 or $100. And here's why that matters so much. This finance income is their safety net. It's a buffer. So when a quarter comes along where the retail fuel margins are squeezed to practically nothing because of regulations, this is the income that steps in and protects the bottom line. It's what keeps them profitable.
All right, let's bring this all home. Section 5, your new investment thesis. It's time to talk about what investors should actually be watching.
So, here's the data-driven view. First, forget about betting on rising crude oil prices. That's the old game. Instead, value the company for its real strengths, its strong liquidity, and its sharp treasury management. You should also acknowledge that it has a stable, roughly 21% market share, even in this more competitive field. And here's the big one. Start watching their finance income as a key performance indicator, not just their fuel revenue.
So the bottom line is this. The 2022 storm is over. That ship has sailed. So the real question for you is, are you looking at the right indicators for LIOC's future? To really get it, you've got to look past the global oil drama and focus on the quiet power of their balance sheet. That's where the real story is being written.
And of course, just a quick disclaimer, this analysis is purely for educational purposes. It absolutely does not constitute financial advice. All the data we've used here is based on publicly available information.